Welcome to Money Minds. What if I told you that debt, often seen as a foe, could be your best friend in creating wealth? Yes, you heard it right. Debt, a term that usually sends shivers down our spines, could be a key player in wealth creation. The perception of debt as a financial bogeyman is quite common. But what if we flip the script? Let's rethink debt. Not as a lurking monster in the shadows, but as a catalyst, a tool in your financial toolbox. It's a double-edged sword, no doubt about it. Wielded wisely, it can carve out a path to prosperity, but mishandled, it can cut deep into your financial health. The rich have been using debt to amass wealth for ages. They use it as leverage to amplify their investment returns. How they do it is a lesson worth learning. It's all about strategic use, about harnessing the power of debt to propel your dreams and endeavors. Challenging, isn't it? Well, let's dive into 5 ways debt can actually make you money. First, consider the realm of real estate. Real estate is a well-known, tangible investment opportunity that can provide you with a steady income stream. Let's break down how this works when you use debt to your advantage. Imagine you are interested in investing in a rental property. You don't necessarily need to have the full amount in cash to buy the property outright. Instead, you can take on a mortgage, which is a type of debt, to finance your purchase. With a mortgage, you only need to put down a fraction of the property's total cost, generally around 20 to 30%. This is where the concept of leverage in real estate comes into play. Leverage is basically the use of borrowed money to increase the potential return of an investment. So let's say you buy a property for $100,000, but you only put down $20,000 of your own money. If the property appreciates in value to $110,000, you've made a 10% return on your total investment. However, when you consider the money you actually put down, your return is 50%. Now, this doesn't mean real estate investments are without risk. If the market takes a downturn, you could end up owing more on the property than it's worth. However, with a rental property, even in a down market, you can still generate income from tenants' rent payments. Moreover, as you pay down your mortgage over time, you gradually increase your equity in the property. This allows you to build wealth over the long term, even if the market goes through ups and downs. It's also worth mentioning that real estate offers tax benefits. The interest on your mortgage, property taxes, and certain expenses related to rental property management can be deducted from your taxable income, further boosting your return on investment. So, real estate can be a gold mine if navigated with wisdom. It's about understanding the risks, doing your due diligence, and making strategic decisions to use debt as a tool to leverage your investment and maximize your returns. Second, ever thought about starting your own business? It's a captivating prospect, isn't it? The thrill of being your own boss, the adrenaline rush of turning a dream into reality. But often the harsh reality of capital constraints comes crashing down. This is where debt steps in as an ally for entrepreneurs. Embarking on the entrepreneurial journey often involves taking on debt. A business loan, a line of credit, or even personal savings can fuel the startup engine. The key here is not to view debt as a liability, but as a catalyst for growth. An investment that, when used judiciously, can yield returns that far surpass the initial financial obligation. Take, for instance, a small bakery business. The owner borrows $50,000 to start operations. With hard work and a sprinkle of luck, the bakery becomes a local favorite. The revenue starts rolling in, and before long, the initial debt is cleared. The owner is now left with a thriving business that generates consistent income, a return on investment that far outstrips the original debt. However, it's crucial to remember that starting a business isn't a guaranteed ticket to success. It involves a calculated risk. The market should have a demand for your product or service, and your business plan should be robust and realistic. This is where financial acumen comes into play. Understanding the market, knowing when and how much to borrow, and having a clear plan to pay back the debt are all part of the entrepreneurial playbook. The world of business is filled with stories of individuals who leveraged debt to their advantage. They saw the potential in an idea, took a calculated risk, and turned a dream into a thriving business. They didn't shy away from debt. Instead, they embraced it as a tool to propel their business forward. That's how many of today's successful entrepreneurs started. They saw potential, took a calculated risk, and it paid off. It's about seeing debt not as a barrier, but as a stepping stone towards your entrepreneurial dreams. Third, investing in yourself through education. Now, this might sound a bit counterintuitive. After all, we're talking about debt here, right? But consider this, student loans, when used wisely, can be a powerful tool for future financial growth. They say, knowledge is power, but have you ever thought about how that power can translate into dollars? Let's put it into perspective. You're investing in your education with the expectation that your degree will open up opportunities for higher paying jobs in the future. It's a long-term investment in your earning potential. That being said, it's important to approach this investment with a strategic mindset. Not all degrees are created equal, and some might not yield the high return on investment you're hoping for. It's crucial to research and choose a degree that aligns with in-demand careers and industries. This will increase your chances of landing a high-paying job post-graduation, which in turn will allow you to pay off your student loans faster. But remember, just like any investment, there's a degree of risk involved. You're betting on yourself and your future earning potential. It's critical to weigh the cost of your education against your potential earnings. Consider this scenario. John borrows $50,000 for a degree in a field where the average starting salary is $80,000. On the other hand, Jane borrows the same amount for a degree where the starting salary is around $40,000. Who do you think will have an easier time paying off their loans? It's also worth noting that student loans typically have lower interest rates compared to other types of debt, which can make them a more manageable form of financial leverage. In conclusion, investing in education is not just about acquiring knowledge, it's about strategically using debt to increase your earning potential. It's a powerful tool that, when used wisely, can lead to financial growth in the long run. Remember, knowledge is power, and that power can translate into dollars. So, be strategic, do your research, and make your education work for you. Cool. Fourth, let's talk about margin trading. Margin trading, in essence, is the practice of borrowing money to buy more stocks than one could purchase with their own funds. It's like getting a boost in a video game that lets you jump higher and further than you could on your own. The main goal is to amplify your profits, making your wins even more impressive. Imagine having $100 and investing it in a stock that you believe will rise in value. Now imagine if you could take that same $100, borrow another $200, and invest $300 in that same stock. If the stock does rise, your profit could be 3 times what it would have been if you had only used your own money. That's the power of margin trading. But like Icarus flying too close to the sun, there are risks associated with soaring so high. The borrowed money needs to be paid back, regardless of whether the stocks you purchased increased or decreased in value. So if the stocks go down, you could lose more than your initial investment. You could end up owing the lender the amount you borrowed plus interest, even if your stocks are worth less than when you bought them. So why do people still engage in margin trading despite the risks? Well, it's because the potential rewards can be substantial. When done right, margin trading can lead to impressive gains. But it requires a keen understanding of the stock market, careful analysis of potential investments, and a strong stomach to weather the ups and downs. In the world of margin trading, knowledge and strategy are your best allies. The more you know about the market and the better your strategy, the higher your chances of success. It's not a game of luck, but a game of skill, strategy, and timing. Margin trading is not for everyone, but for those who master it, the sky is the limit. Finally, let's delve into leveraged ETFs. Leveraged exchange-traded funds, or leveraged ETFs, are a type of financial instrument that use debt to amplify the potential returns of an investment. They function by using borrowed money or leverage to invest in an underlying index or asset, aiming to deliver multiple times the daily performance of that index or asset. So, if an index goes up by 1%, a 2 times leveraged ETF would aim to go up by 2%. However, it's important to remember that while the potential for higher returns is appealing, leveraged ETFs are not without risk. Just as they can amplify returns, they can also amplify losses. If the index or asset doesn't perform as expected, you could end up losing a significant portion or even all of your investment. Moreover, leveraged ETFs are complex financial instruments and not suitable for all investors. They require a deep understanding of the financial markets and careful management. Therefore, before diving into leveraged ETFs, it's crucial to do your research, understand the risks involved, and consider seeking advice from a financial advisor. Like all debt strategies, leveraged ETFs require a keen understanding and careful management. Well, there you have it. 5 ways debt can make you money. Let's take a moment to recap what we've covered. We kicked things off by exploring the idea of debt as a friend or foe. Remember, it's all about perspective and strategy. Debt is a tool, and like any tool, it's the way you use it that determines your outcome. Next, we dove into the world of real estate. Investing in property can be a lucrative venture, but it's essential to understand the market and the inherent risks involved. Using debt wisely in this arena can help you build a stable, passive income stream. Then we discussed the exciting journey of starting a business. It's a risk, yes, but one that can pay off in spades. Leveraging debt to finance your business could be a game changer, allowing you to take that leap of faith. Our 4th strategy was investing in education. Knowledge is power, and in many fields, it's a ticket to higher earnings. Taking on debt to finance your education can be a smart move, but it's crucial to consider the return on investment. We then navigated the complex world of margin trading. This high-risk, high-reward strategy involves borrowing money to invest, potentially magnifying your returns. However, it's not for the faint-hearted and requires a deep understanding of the market. Our last stop was the realm of leveraged ETFs. These financial instruments can supercharge your investment returns, but they also come with substantial risk. It's essential to manage this risk carefully, and remember, it's not a strategy for everyone. So that's our whirlwind tour of how debt can make you money. Each strategy carries its own set of risks and rewards, and it's crucial to understand these before diving in. Remember, debt can be a powerful tool in your wealth creation journey. Use it wisely, and it could be your best friend. Thank you for joining us on this journey through the world of strategic debt. We've covered a lot of ground today, from real estate to margin trading, and we hope you found these insights valuable. Remember, debt can be a powerful ally in wealth creation, but it must be used wisely and strategically. It's not about accumulating debt, but about leveraging it to create opportunities and expand your financial horizons. It's crucial to do your own research, understand the risks, and never invest more than you can afford to lose. If you've enjoyed this video and found it useful, please consider subscribing to our channel for more insightful content. We're dedicated to helping you navigate the complex world of finance, and your support means the world to us. Until next time, stay financially savvy, and remember to make your money work for you.